Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over Ferrari stock because the stock today is having one of its worst days in the past 10 years. The stock is down almost 15% because of some news about their future guidance and unveiling of new vehicles. So let's get into Ferrari stock. Taking a look here at Ferrari stock here, as we said, the stock is down nearly 15% at 13% down today. But if we take a look at the past performance, it's still a very good performer. Ferrari has been an insanely good performer, and I've been very interested in this company. However, the stock continues to go higher and gets more and more expensive over time. I believe this company has a very good moat because of the brand around it. These are one of the only companies that I believe the brand is actually pretty superior, and they do offer pretty good cars that people want to buy. And the reason I believe that this company does have a good moat, not just because of the brand, is because they're kind of they're kind of having a duopoly. They kind of have a duopoly with other supercar companies like Lamborghini, which is owned by Volkswagen, which they also own other supercars. So Ferrari doesn't have a huge amount of competition, which is why I like it. There's not a lot of supercar companies out there, and Ferrari is one of the best to do it in terms of financials. But taking a look at why Ferrari stock is down here, looking at shares of Ferrari on Thursday today, after the luxury car maker updated its full year in 2030 guidance and scaled back its electrification ambitions. Analysts were disappointed by this new guidance here. As we can see, it expected net revenue of at least 7.1 billion euros, which is $10.7 billion, up from a previous forecast of more than 7 billion euros. Net revenue is expected to be around 9 billion euros in 2030. The company is targeting earnings before interest, which is the EBITDA, of at least 3.6 billion euros by 2030. So the stock price tumbled after this news because, as we can see here, analysts at City Center Research note that Ferrari's guidance falls below our lower growth case estimates from our preview. So they believe that this is very conservative and lower than what they have wanted. As we can see here, it implies limited operating leverage through the coming cycle. We think there's some risk to both consensus EPS and multiples near term. So taking a look at why another reason the stock is down here is looking at another update that Ferrari did today is their target for 2030 sports car model lineup made up of 40% internal combustion engine cars, 40% hybrid, and 20% fully electric vehicles. Ferrari said the revised target, which is down from a prior goal of 40% EV sales by the end of the decade, is the result of a client-centric approach, the current environment, and its expected evolution. And with that being said, looking at this, Ferrari says the pivot comes as the Italian carmaker lifted the hood on the technology set to maintain its maiden electric vehicle. Ferrari unveiled the production-ready chassis and powertrain of the Electrica during a technology and innovation workshop, saying it would start deliveries of the model in late 2026. The completed car is expected to be launched at a global premiere next year. So with that being said, they did reduce their electric vehicles outlook. I think that's the main reason the stock was really rallying. Also, because of their good fundamentals. We'll get into the fundamentals of Ferrari. Their fundamentals is very good actually for a car company, and their margins are very good. But I think the problem is the stock was hyped up due to electric vehicles and the potential for electric vehicles. And when you revise that projection like Ferrari just did, it kind of hurts the stock here. And as we saw, yes, it does, because that people really think that electric vehicles could be the next thing, and once they start to reduce their outlook on electric vehicles, it kind of makes it worse for Ferrari. So going over to my valuation investing website, if we type in Ferrari or race, we can see here obviously Ferrari, if we didn't know, most people know what Ferrari does, is a luxury car brand where they basically make supercars. But the thing I want to get into is the basic fundamentals of Ferrari, which I believe this company is a very good fundamental company. As we can see here, the market cap of 88 billion. So this company is pretty high valuation. Taking a look at the PE ratios, it's a bit high at around 40 and 43 for the forward PE ratio. The price to sales is pretty high too. So that's the only problem here. The price to book is also not great, but also taking a look at the free cash flow yield. The free cash flow yield, you want this to be high as possible. If it's higher, that means you're getting a greater percentage of free cash flow. However, here with Ferrari, we see we only get 0.75%, and that is very low. Normally, even software companies don't trade that low. Anywhere from 2 to 5% is where you want this at worst to be, but as we can see here, it's at 0.75%. The margins, though, however, very good at 23% for Ferrari, and the net cash is not great at negative 2 billion, so they have about 2 billion more in debt. But taking a look at the 7-step stock analysis here, we get 4 of the 7 key metrics for Ferrari. As we see here, the Ford P ratio is a bit high at 43.6, so the valuation is up there for Ferrari. The return on invested capital looks pretty good, especially for a car company. They're good at reinvesting back into their business. The revenue growth also looks really good. EPS growth looks very good. They're buying back some shares, and that's also good. And the debt to free cash flow, 5.5. Future revenue growth analyst expectations, I think that's wrong. So this could be 5 out of the 7 key metrics. Honestly, I don't think it's going to be 4%. But let's go to the intrinsic value calculator to get a fair value price for Ferrari and to see if we should be buying the stock today after this huge drop. First, for the bear case, I think Ferrari is going to continue to grow this revenue at a very good pace. If we go back and take a look at the financial charts for Ferrari, they continue to grow every single year with the revenue. The EPS continues to grow every single year, so this looks very good for Ferrari. Also, the free cash flow, everything's growing at a pretty consistent rate. I think for the bear case, this company will grow at about 8%. For the base case, I think Ferrari could grow 13%. In bullish case, say Ferrari starts to really get into EVs, I think it can get to 18%. Looking at what it is today, it's at 16%, so it's barely even acceleration from today's growth with the bull case. I think that's with EV continuing to grow. And I think also another good thing for Ferrari is that this company is a consumer discretionary company, meaning when the economy is doing really good, this company will also benefit. But I do think one good thing is as income disparity gets greater, which I mean by income disparity, when there's going to be more and more rich people, and then there's going to be more and more poor people. The gap between that is getting larger every single day. So with that being said, this is actually going to help Ferrari because more and more people are going to be very rich and they're going to continue to buy Ferraris. And I think that is another good positive with Ferrari. Now for the profit margin, we can see the profit margin is at 23%. Right now, I think with bear case, it would be 21%. Base case, I'm going to do 23, and bullish case, 25. I think bullish case, if it gets to 25, that could be from EVs, and say they start to charge more, I think that could get up to that 25% profit margin. Now for the future P ratio, with the bear case, I think this company deserves a 20 P ratio. Base case, I'm going to put a 28 P ratio. Bullish case, I'm going to do a 36. I think if a company is growing at 18%, they deserve 30 to 40 P ratio. Now for the shares outstanding, I think they're going to be buying back at 0.5%, bear case. Base case, buying back at 1%. Bullish case, buying back at 1.5. With that being said, if we calculate the intrinsic value, I actually get a 6% return on Ferrari today. So if I wanted a 10% return, I need this under $350. So me personally, I'm not going to be buying Ferrari right now. However, this company is very interesting to me and I do like the business as a whole. I think this company is definitely worth a more premium price. And I do think if we do get to the low 300s, I would buy this company. I think Ferrari has a great growth outlook for the future. They have a great brand. And this is one of the only times I would say a great brand is actually a good moat. Normally, I would say brands isn't a great moat, but I truly think Ferrari is a good moat. So with that being said, thank you guys for watching this video on Ferrari stock. The stock is down a lot today, but I still think today we shouldn't be buying the stock, but do your own research. And if you want to go check out the valuation investing website, either look up valuationinvesting.money or sign up with the Patreon. Click right down here. I think it is somewhere here. Click down there and you'll go to the Patreon. You can get a 7-day free trial. So thank you guys for watching and see ya.